Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And this is an emergency Fed episode because I think it was Monday evening after we recorded an entire podcast on Repocalypse, we got a news story that came out about how Trump fired one of the Fed governors, Lisa Cook, accusing her of mortgage fraud. And so we wanted to hop on to go through some basics about how the Fed works because we say this all the time. Never let a crisis go to waste. People care about different things that they otherwise would not when things are about to break. And so I saw that the Daily did an episode on the Fed, and I was like, all right, somehow it's breaking into the mainstream, Jen. She's rolling her eyes. we got to hop on and do an episode on the Fed. So one of the things I want to establish with this episode is I want to have just one place where we can go through a bunch of the basics. So like, what is the Federal Reserve? What is their dual mandate? I also want to talk about like the actual difference between the FOMC governing body, who makes up the various components of the FOMC versus like who's going to show up on the dot plot and like how people get nominated and approved to these different positions, because this is really important for understanding like how interest rate policy is set. We're then going to talk a little bit about how the Fed funds rate is set. Again, the relationship between Fed funds and some of the longer term rates. And then, is it actually legal? Can Trump actually fire this woman, Lisa Cook? So I want to start, Jen, with just like, can you give us a high level understanding or overview of, first of all, like what is the Fed and why is it so important that the Fed be at least perceived independent from, say, the executive, from the president?
Well, I think, first of all, we need to establish what the Federal Reserve is. So the Federal Reserve is the central bank of the United States. But what it actually is comprised of is 12 member banks in different regions of the country that oversee and are responsible for keeping basically the financial system humming along. We have individual Federal Reserve presidents who are the president of each of those individual banks. We then have the governors of the Fed, who are independent experts who effectively run this committee that governs all of the member banks and oversee monetary policy and try to achieve financial stability within the system. And so we have our 7 governors of the Fed, and we've got our 12 Fed bank presidents. So all told, we have 19 people in the giant operation that is the Federal Reserve. But we only have 12 voting members on the Open Markets Committee, 5 of whom are Reserve Bank presidents, one of whom is the Reserve Bank of New York, so that's always a fixed thing. 4 who will rotate in and out of those positions. And then we have our remaining 7 governors, of which we have Jerome Powell, who is currently the chairman, who has the greatest amount of sway and influence, but does not make unilateral decisions. And that 12 votes on a majority rule basis. All 19 members, though, of this Federal Reserve System will contribute their thoughts and writings and opinions about monetary policy at various points throughout the year. But it is that 12-member Federal Open Markets Committee that is the one that votes and makes ultimately that decision about monetary policy that is what you hear about in the press as the Fed met and decided this.
Yeah. Well, and I think that, so when I heard about the firing of this woman, Lisa Cook, what I wanted to then really understand is like, how are these different people getting appointed? Like, how are they becoming Fed governors? How are they becoming Fed presidents? And so what's interesting is that, to your point, there's 7 Fed governors. They have like 14-year terms, with the exception of, again, obviously the Fed chair, he serves a 4-year term. Now, they do have to be Senate confirmed. And I think that that's a really important point that, you know, Trump has just put up this person, Myron, but that person has to ultimately be approved by the Senate. Now, the other thing is the Fed presidents, they actually serve 5-year terms. And what's really interesting is that their term is expiring February 28th of 2026. So they have less than 6 months left serving as president. And so if we think about, again, the goal that Trump has, right, he would like to have sway over the entire FOMC. Like, you need a majority of the FOMC for interest rates to be lowered. So there is the governors. And right now, there's 2 that Trump appointed, Christopher Waller, and then we have Michelle Bowman. Now,
and Waller is kind of, by the way, like the, I would say, leading man for the person who's going to likely succeed Powell.
Yeah, and at the latest meeting, I think it was Bowman and Christopher Waller who both dissented when they decided not to cut rates. And as people have been saying, like, Waller is kind of auditioning to be the new Fed chair. By the way, the Fed chair has to be a governor, by the way. So just as a lovely little wrinkle. But so in the sort of perfect world, Trump wants to sort of have the majority of those 7 on his side. One of the prior Fed governors, Kugler, she actually left. And so Trump has, again, nominated this guy Mirren to replace her. And then, so you think about like there's 7 members of the governors. He has gone after number 4 to try to get the majority. Now, the other wrinkle, as we said, is that you have these presidents who are also coming up for term expiring. And what's interesting about them is that they have to be approved by the governors. So in theory, you now have a president who, via these governors, by having sway over the governors, theoretically can influence who the presidents are as well. And as we said, right, the voting committee is made up of the governors and then those 5 presidents, right? The 1 permanent one and then the 4 that rotate. So I think that that's just a really important thing to understand, is that because of how all the things are being stacked and how all the chips are falling, we theoretically do have a situation where the president may be able to have his thumb on the scale of how the Fed works. With that said, Jen, can you talk about why that might not be the best thing to have happen, even if that's what Trump wants?
Yeah, so I think the concept of central bank independence is something that goes back decades. And we have talked about ad nauseum on here the example of the Bank of England as a classic example of why that independence is so important. And what the Fed's ultimate responsibility is with controlling monetary policy is to achieve its dual mandate, which is to maximize employment. There is no hard and fast employment target, but it's just to basically maximize it while simultaneously keeping prices stable. And so historically, they've had a 2% inflation target, then moved it to a floating inflation target, and now it's back, and then we got rid of that, but whatever. Effectively, thinking about and keeping inflation in check. And you can use that 2% number as still a nice round number in your head if you'd like as some measure of it. And why that matters so much is if you think about it, if interest rates are just set willy-nilly at the whim of whatever regime happens to hold political office, at the whim of whether or not you had a good or a bad day, or one bad jobs report, or one high inflation number, then all of a sudden you have massive uncertainty as to what is reality. There needs to be some measure of objective truth in the system of, okay, well, 1 + 1 = 2. We need some kind of independent arbiter to agree to that, right? Rather than saying, well, my 1 + 1 = 5 and your 1 + 1 = 7. And the 1 was really drawn like a 7 or whatever it is. So I think that it's very important to have this ostensibly nonpartisan committee that says, okay, well, who cares who's in office? Who cares what is going on? We can't control what's happening with the fiscal picture, right? With the Treasury. That is part of the federal government that is tied to the executive branch, that is tied to whatever party is in control of the country. So if the Treasury is out completely offsides and is, whatever, running up a massive deficit, let's say, and spending irresponsibly or whatever it may be, the Fed's job is to be almost like a counterbalance to that. Not that there needs to be a monetary policy solution to every fiscal problem, but you need them acting independently, or else one can just compound the problems of the other and vice versa. So if everyone's under the same umbrella, then you're just going to get partisan action whichever way the wind blows. Now, the reality is nothing is ever nonpartisan truly, because people are human, right? And they are going to enact things based on their beliefs and based on their particular biases. So I think it's less about the idea that all of a sudden we are now going to have a partisan Fed and we didn't before. I think that's naive to think. But it is about perception, that if you think that you've got governors who could get taken out and shot for, hey, you got a B+ on a chemistry test when you were in high school, therefore that's cause and you're out. Mm-hmm. Are you necessarily going to make the same kind of tough decisions that you were if you felt like your job weren't in peril based on political whims? And B, whatever decisions are made, even if they are made independently, might be seen without that same level of independence and credibility that this is the best path for monetary policy based on we are economic experts. We understand monetary policy. These people all understand how the financial system should theoretically work, and therefore aren't just saying like, well, today feels like a day to cut rates or today feels like a day to hike rates. So for me, it's less about the idea that Trump does or doesn't have his thumb on the scale, because every politician has always had their thumb on the scale with the Fed. It is about the perception that whatever decisions are made are politically motivated potentially, and thereby lose all credibility. That is why we are so careful to not talk about our own personal politics. By the way, all of you who think you know our politics, I guarantee you don't. We never try to add our personal biases to things, because that colors the way in which you think someone is teaching you. If you think that I hate Trump and I'm saying this, you're like, that's just because she hates Trump. And if you think I love Trump, you're like, why is she saying that? If she loves Trump, I don't understand. Like something must have happened. They got to her, whatever it is. None of this is politically motivated. I'm just telling you what the actual reality is of how these systems work and how they have historically worked.
Yeah.
What goes from here, maybe we enter into an era of unprecedented prosperity as a result of President Trump, in your words, having his thumb on the scale of who is on the Fed Board of Governors. That's entirely possible. I have no idea. But what I do know is that as a neutral observer, if all of a sudden these appointees aren't organically turning over under different administrative conditions and are being singled out, it gives the appearance, which is sometimes more powerful than whatever the actuality is, of impropriety and of the executive branch meddling in monetary policy.
Yeah, it's so interesting. I remember hearing some experts who were talking about inflation, that it was really the expectation of inflation that was so important, because it's like, if you expect that next year your grocery bills can be higher, or that you're going to have a higher salary, like it influences how you spend today. So much of everything is the expectation of things. And that's why it's so important, to your point, to kind of like make sure that what people perceive is not that there's going to be like runaway inflation. And so even, for example, like the potential, it used to be the firing of Powell, which I feel like Trump has stepped away from, but it's that perception, which then spooks the markets. They feel like, oh my gosh, there's going to be runaway inflation. And then it's like a self-fulfilling prophecy, much more so than so many other things where it's like, the data's the data. It's like, no, this is all about expectations, because people plan and they do things based on what they expect to happen in the future. So with that being said, so we talked last week, and I loved your rant about how it's like, it is not just Chairman Powell who sets rates, it's this Federal Open Market Committee. And like we said, right, there's the 12 members who vote. It's actually like not a set rate. And I'd love if you could talk a little bit just about like this Fed funds rate. It's the overnight rate that banks borrow at, but like, how do they actually set that? It's not like they're just like, this is the rate, and then they plug it into some formula. Like, how do they actually set that? And
well,
it's the range.
So the Fed has a toolkit, right? So it is a range, that is correct. And so they don't set it. They say, hey, we're going to keep it within these bounds. And then they use the tools in their toolkit to create that cap and floor on that range. There's two ways that the Fed sets the effective floor on Fed funds, and two ways that they effectively set a cap on Fed funds. So the two ways that they set the floor are, banks have excess reserves in their coffers, right? So beyond what the regulator requires that they keep in terms of cash on hand, they can park those excess reserves at the Fed and earn interest on them. There's also the reverse repo facility, which is where institutions like money market funds can park their excess cash at the Fed, and that's called the reverse repurchase facility or the reverse repo facility. So I talked about that ad nauseum earlier this week. But that's basically where the Fed becomes the borrower of last resort, and they are willing to pay the bottom of the Fed funds range on all of that cash that is parked at the Fed. Then we have their way of setting a cap on the Fed funds range. And there's two ways for that. There's the effectively standing repo facility, which we talked about, that was implemented as like the solution to repocalypse in 2019. And so they effectively lend cash collateralized by bonds, and they receive interest on that loan. And where they're willing to receive that interest then becomes the cap on where that rate is, right? Because if you were to go try to borrow money somewhere else, you might get charged through the roof. You could go to the Fed and get charged just that upper bound. And then there's also the discount window, which is basically where the Fed makes short-term loans to commercial banks, where the Fed receives interest on that loan. And that is a way for banks to access emergency liquidity if they need it, and keeps a cap on that. So beyond those two kind of just like ways to keep that rate functioning, the Fed also has their open market operations where there's quantitative easing, which we've talked about ad nauseum, where they are purchasing bonds, and there's quantitative tightening where they are de facto selling bonds by letting them roll off their balance sheet. So those are like the three primary categories of tools that the Fed has to keep rates within those bounds. They don't just say, okay, the Fed funds rate is 4.25%, and then everyone says, no problem, boss, like we'll do it.
So you said that there is a range. And so one of the things that I am curious about, because when I went through my interviews back in 2006 and 2007, I remember I would have to memorize that the Fed funds rate was 5.25%. When did it change to a range? Or was it a range and I was misunderstanding that it was a range at the time?
No, that's such a great question. So I think one of the things that's helpful to understand is rates were not zero until the financial crisis. So when the Fed effectively had to drop rates to zero in 2008, they set a target range instead to provide that cap and floor for their target rate range. So rather than having a target rate where Fed funds effective would vary slightly relative to that target rate, all of a sudden, when you have rates set at zero, it was helpful to set that range of 0 to 0.25% to 25 basis points to keep a cap and floor, as they then implemented these additional liquidity facilities to provide stability to the system.
Got it. Okay. And then speaking of which, we've talked about this in multiple other episodes, but I think I want to really hammer it home here that the Fed controls the overnight rate if they are just setting the Fed funds rate. However, back in 2008, we talked about how they brought out the bazooka, they brought out the big guns, and they started to step in and did that what's called quantitative easing, where they went out and they started to actually go into the open market and buy longer dated bonds. And the reason for this is if you think about the yield curve, like this is how I always have to kind of process things so that I have almost like a visual that I can, I don't know, like diagram in my head that again, Fed funds is the overnight rate. So if we think about the yield curve, you have, again, the different years on the x-axis and you have the rate on the y. And so the overnight rate, again, is the rate that is set by the Fed. What's going out longer in the yield curve, that is set by the market. That is set by buyers and sellers who are just deciding like, okay, this is my expectation of what I think the inflation picture is going to look like, and I want to buy and sell longer dated bonds. But so the market is setting those longer term rates. If the Fed wants to come in and put their thumb on the scale and lower rates, they need to potentially start to do these open market operations where they buy bonds and they buy other stuff as well, but that can help to lower the long end of the curve. However, doing just like setting the short-term interest rates, that alone without the quantitative easing is not necessarily going to cause longer-term rates to drop. In theory, it should, but it doesn't necessarily, because the longer-term rates are much more an expectation of what is inflation going to look like in the future. And Jen, you have talked about how in Europe, we had a whole episode on this, how in Europe, we've seen—
Two episodes now. The long end of the curve is vulnerable.
The ECB has been cutting rates, and yet the longer-term rates have been selling off. And so the point is that the relationship, again, between short-term rates and long-term rates, or I should say, the point is that longer-term rates are not necessarily controlled by the Fed without some additional interventions.
Think about it this way, and I hate using diet culture as an example, but it's literally the example just came into my mind, so you're going to have to deal with it, okay? When you think about what your physical health and weight is going to be 30 years from now, does it really matter whether you had a salad for dinner or a cheeseburger? No. 30 years of your culinary discipline is what goes into your weight 30 years from now. So if you're thinking about Fed policy and how you impact those longer term expectations for what interest rates will be in the future, it matters much more what our fiscal discipline looks like than it does where you can borrow and lend money for 24 hours.
Yeah.
So think about it this way. It's like, okay, well, do you intend to maintain a balanced diet and exercise and, fitness routine or whatever it is for the next 30 years of your life? If so, then expectations are going to be that your weight will stay relatively stable over that time frame. But if you think, well, we're having a salad for dinner tonight, but I know we're going on a binge for the next 7 days and we're going out drinking and we're going out partying, we're going to have lots of pizza. Okay, well, it doesn't really tell me that there's a pattern that leads to the expectation that your weight is going to be the same 30 years from now.
Mm-hmm. Yeah. So that, again, I like that example. Because,
just came to me. Thanks.
Yeah. Again, analogies are always, I think, the best way to learn. But the last thing, and by the way, just sort of bringing this back to, I think that, Trump has said this, like the motivation for wanting rates to be cut is he wants mortgage rates to be lower, and just because
is that, but like, I don't think that that's just
part of it. Interesting.
Yeah, I think that's part of it. I think that, and this is where I'm starting to develop more conspiracy theories, if you will. I think that part of it is lessons learned and learning maybe the wrong lessons. That if you look at the stock market, if you look at the economy during really low interest rate regimes, everything was gangbusters. Yeah. And it's the same thing of the people on our Instagram DMs who say like, I can't buy a house because rates aren't 2%. When will they be 2% again? Things have to get really, really bad for rates to get down to 2%. Be careful what you wish for because you just might get it. And so rates were lowered in response to a massive global financial crisis. We brought out all of these emergency measures. And then as a result of all this excess liquidity being pumped into the system, it was a bonanza for risk assets. So I think potentially the lesson learned from that is that when rates are low, the economy is great. But that's the wrong lesson to learn, if you will. It's almost like learning the lesson of like, wow, when I'm on heroin, I feel fantastic.
I was going to say, it was like, the lesson of 2020 is, like things were great. And then we had 8%, 9% inflation. Like that's why then rates had to go up. But during 2020, the heroin felt great.
No, but it's like, you know what I'm saying? Like, oh, I'm on Oxy. Oh, it's like, because you just had surgery. Like, that's why you feel.
That's a great analogy.
Amazing, right? But you just had surgery. So all of a sudden, when the painkillers wear off, you're going to be sitting there with staples in your side, so I think that maybe the wrong lesson was learned.
But that's but the thing is this 4-year. Yeah.
What indicates that to me is the fact that was the reaction to the BLS. So it was rates need to be lower and the economy is so much better than the labor report is indicating. Those two sentences mean totally different things. If the economy is so much better, based on the Fed's dual mandate, they in fact do not need to lower rates. So if the economy is doing so well, why do we need to lower rates? So you cannot have both. One can create the other, not the other way around. That's
such a good point. But back to it goes back to the Fed independence. Like the reason you don't want to have the president put their thumb on the scale is they only care about the 4 years that they're in office for the most part. Like they want things to look great while they're in office. And then when they leave, it's somebody else's problem. And so, if you cut rates now, things look great. But then same thing that happened in 2020 when the, 8, 9, 10% inflation is kicking around, like deal with that next administration. Like, I don't want to deal with that. But by the way, my stock market was great. So I think that that's a really good point. But again, this goes back to why you want to have the independence of the Fed and the president, because they have very different goals.
And sometimes the Fed has to make really hard decisions. Yeah. And the market will disagree with the Fed. The Fed and the market have not always been in tandem. And, the question is who is bigger? Now, it always used to be, don't fight the Fed, right? The Fed is bigger than you, the Fed, et cetera, et cetera. But you can fight the Fed potentially if the Fed doesn't feel independent. That's the lesson I fear that the market will learn. And that's a very, very dangerous lesson. Because what if the market wants to do something that isn't necessarily in the best interest of the economy? That becomes a very, very scary place.
Well, it's like the kids. It's for the same reason that you don't have your kids like choosing what they want to eat. They're going to probably pick to have ice cream for dinner. Like you need the adult in the room. The adult is supposed to be the Fed who's looking longer term versus like the kid who's the president who's like, I just want to have, again, the sugar rush or the Oxy or whatever it is. Like,
I can't believe Oxy. I'm reading a book called The Poppy Wars. So like heroin is top of mind for me. Sorry. Like
I was going with it and then I was like, maybe this, but anyway. So last really quick thing. Well, there was two more I think points that I wanted.
Hang on. I want to talk actually about Lisa Cook because we talked about Lisa Cook 2 weeks ago, I want to say, when the headline initially broke.
Last week. Yeah.
Yes.
But that's literally the last thing I wanted. So yeah.
Oh, good. Yeah. So the Fed governor who Trump is trying to fire with cause has been accused of committing mortgage fraud. We explained what that was. We explained what was on the table, but no formal charges have been filed. And I guess what the chair of the FHFA, so the Federal Housing Finance Authority, is saying is that she took out a loan on a Chicago property declared it as her primary residence, and then 2 weeks later went and obtained another loan on a condo in Atlanta, and then claimed that as her primary residence. So Kristen, you can talk about kind of all of the ins and outs of this, but what I just want to establish very quickly is, in order to fire someone for cause, I think we need to all agree that like cause isn't, a concept of an accusation. At the very least, I think we need to go through due process where formal charges need to be filed. That person needs to then be found guilty, and then cause is established. And then there's discretion as to whether or not that cause is worthy of dismissal, which I'm perfectly happy to have that conversation. What I think is very dangerous is setting the precedent of, hey, I'm going to make an accusation that you looked at me funny, and therefore we've now established cause. I think that's a very dangerous, and I'm not a lawyer, but I think that's a very dangerous precedent to set, period, full stop.
Yeah, well, I think it's also, if you follow someone long enough, like in a car, you're going to find them speeding. When you've established that you can fire someone for cause, but now like you can look into every single aspect of their life and say, here's this one little thing, like you jaywalked when you were in this. So it becomes a little bit dangerous there too, especially when these are accusations that are not being applied uniformly. If you're gonna say, hey, we're gonna go after all people who were on the Fed and look at all their mortgage records, and like this is going to, or everyone in government, and by the way, we're equally attacking the Republicans and the Democrats, or the people appointed by Republican administrations and Democrat, then okay, like this is we're setting it and we're going to do this for everybody. But when you're saying I can now look into every little thing, every little tax record, every little and find the one little thread, and we already saw that the administration was trying to go after Powell for these renovations, it seems like that was not working. So it then became, okay, well, now what's the next best thing? I'm going to go after Lisa Cook for this mortgage fraud. And by the way, who else has gone after for mortgage fraud? She's not the only person. They're going after Letitia James, who had gone after Trump in New York. They're going after Adam Schiff, who was part of the January 6th committee. So this feels very politically motivated. If there was some Republicans who were thrown in, I'd be like, okay, like seems like they're doing, this is everybody. But I don't believe for a second that this is just like haphazardly, oh, look, here was this horrible thing she did. Now she needs to be fired. I think that that's the perception issue.
Well, I think we have been going down a path of weaponization of the courts in this country. This is not the beginning of that path. I don't want to get into a he said, she said, or like a who started what. All we're talking about is the matter at hand. And I think that matter at hand sets a very dangerous precedent, specifically for this one body that needs to maintain independence. And if there is an investigation, if there are formal charges filed and there's an investigation, my personal view is that committing a felony based on it's funny, there's this old 30 Rock episode where there's the Generalissimo. Do you remember this? And it's like the misuse of the mail. It's like oh my God, it's one of my favorite. But if you are in charge of interest rates and you are committing felonies with respect to interest rates, to me, that is a problem. That's a much bigger deal for you than if you are a bartender and you had committed mortgage fraud. I could see your general manager being like, well, that's your problem, right? Our policy is XYZ, we can maybe apply some discretion here. I can totally understand the case then for that being cause. But I do think that we live in a world where it's innocent until proven guilty. And I do very firmly believe in due process. So I cannot render a verdict on Dr. Cook until there is a guilty verdict against her, and until there's even charges brought against her. She hasn't even been formally charged. Right. So that's why this is so concerning to so many people, understandably.
Yeah. Well, I did think it was ironic. There was a huge lawsuit against Trump. He was found guilty of lying to get a lower interest rate. And that was, and by the way, there was a settlement that was for an absurd amount of money that was ultimately thrown out because of how absurdly punitive it was. But it is, like I said, ironic that now they're going after all these people for kind of doing the same thing. So it's like people in glass houses. I
also just wonder if this is kind of the beginning of the end for the Federal Reserve. You've got, I just don't know. We went on Dan Nathan's podcast earlier this morning. We were talking about the dismantling of all these institutions. And the Federal Reserve wasn't established in 1776. Like, it is an invention of the quasi-modern era. And it functions in a very specific way. And if it ceases to function in that very specific way, or if it's called into question the need for it to function that way, I'm curious to see, like, is this a blip in the history of the Federal Reserve? Is this the beginning of a new era where we no longer have the Federal Reserve as we, previously have? I truly have no idea. It may be a whole lot of nothing, because I also do think that there is this tendency within the administration to be very, very extreme in communications and then walk it back the next day.
Yeah. Well, it's like it's like a trial balloon, like to see what the reaction is, and then be like, okay, like that wasn't what I wanted. Like, let's back off.
That's how it felt with Powell, right? It was like, I'm going to fire Powell. And the market was like, nah, you're not. And he was like, you're right. No, I'm not. Nah, Powell and I were buds. We go way back. We just like to mess around, right? Yeah. So it could very well be that, oh, okay, well, I'm going to fire Lisa Cook. And it's like, no, you're not. It's like, nah, Lisa and I were buds. Like, we're besties. Like, don't worry about it.
Well, because you had said that there was that twist in the in rates when he announced that.
Overnight, yeah. So the immediate market reaction is the curve steepened out in both directions, right? So you had a bear steepening in the long end, you had a bull steepening in the front end, right? And it was what the market was telling us. The way I interpreted it was, okay, so we have no long-term discipline, but in the immediate term, we're going to get more rate cuts.
Yep.
So that's what it seemed like to me. Everything we're talking about with this, our diet analogy.
Yep. So anyway, hopefully this was helpful. Like I said, we wanted to come on and just get some of the questions answered. I actually was asking Jen because I was curious when this came out. I was like, well, hold on. Like, how many governors are there? How many people are voting on the FOMC? What is the terms? What are the rules? Who votes who in? Because I wanted to understand this sort of bigger question, which is like, how much sway can the administration have on the Fed? And to do that, I wanted to sort of get a deep dive into, okay, these are the various players. This is how they're elected, or this is how they come to be that member of this committee. This is how they vote. And so wanted to almost like answer those questions. And obviously there's no better expert. Well,
no, I was mortified to admit that. I was like, I don't really know. Like,
well, because again, why would you care? Because that's the thing. You only care.
You know that there's a committee. You know that it's majority rule. You know there's a bunch of people on it. 12, but then there's 19 dots on the dot plot. We didn't even talk about the dot plot, by the way. Everyone gets a dot on the dot plot. But not everyone votes every time on the dot plot. Sometimes people are like, I was sick that day and I didn't put my dot on the dot plot. So it's 17 dots on the dot plot, or 18 dots on the dot plot, or like I abstained, or whatever.
And the dot plot, by the way, because I know this was something that was new to me like 3 years ago, but it's just all the various members of the Fed, so both the presidents and the governors, they put anonymously what their expectation is or what they think the interest rate should be. But it's anonymous. And so you can see.
And it's a projection into the future. So it's not just, okay, where we voted at this meeting. It's here's what we expect 1 year from now, 5 years from now.
Oh, interesting.
And you can see the distribution of where people are. And this is released quarterly, I want to say, to just give additional insight into what's happening at the Fed, because there were all these like Wall Street quant code breakers being like, this semicolon like was done in a bold font. Now it's, okay, well, here's kind of what we're thinking, right, guys? Like, it's not so much of a mystery. This changes from quarter to quarter, and now every dot's placement is analyzed. Like, who's that dot? That dot.
Who's that dot?
Like it's Waller, like, so there's, but yeah, so that was confusing to me, because I was like, 19 is the number I have in my mind, but there's 12. So like, who are these people? And truly term length and stuff like that. Once you get into term length, my brain switches into politics mode and I tune out.
Yeah. But again, back to like, I think things become a little more interesting when they're about to break. So if this was helpful, please leave us a written 5-star review, share it with a friend or anyone you think might find this interesting to learn about the Federal Reserve. And we will see you guys in a few days, most likely.